A lot of investors believe that when the Fed finally pulls the trigger on rates, as it's widely expected to do in the middle of next month, that there'll be a flow of capital out of the mega cap tech stocks in particular into smaller cap stock. You question that narrative. Why?
I question how far it will go. I think a lot of investors are thinking that that this is going to be a major shift, not unlike what we saw in 2001 coming out of the dot-com bust. But what's different this time is back then, Greenspan cut rates from 6.5% all the way down to 1%. That's not going to happen. You know, right now everybody's banking on 200 to 250 basis points between now and the end of next year. I think they could be disappointed with that. Right now, government spending is off the charts. And that's going to continue to feed the inflation beast. And I don't see either side of the aisle willing to address, you know, some of those key issues. So I think we're seeing a reversion to the mean. You're going to see some of that. And a lot of these stocks should do better. But I don't think it's a paradigm shift away from these larger names. And
you also caution against, it looks like, investors buying an ETF that would track the Russell 2000 index, the benchmark small cap index in the U.S.
There's a lot of garbage in that index, a lot of zombie companies. As a matter of fact, if you look at the index as a whole, as it exists, it's actually more expensive than the S&P 500. You have to go down to small cap value to get some real value. I would say if you're going to go in an index, you want to get into small caps, choose an active manager that specializes in that space. They can provide a lot of alpha there. It's very difficult to beat the S&P 500, but a good manager can beat the Russell 2000. Okay,
so what is your view then on the stocks that have dominated the market for so long, the mega cap tech stocks?
I think it depends on what you're talking about. We had some hits and misses within this season. You know, certainly I thought Meta was just outstanding. One of the true beneficiaries of AI. They're actually benefiting right now. It's not like something in the future that's happening. It's hitting their bottom line right now. I question, and I'm an owner of Alphabet. I have reduced that position because I don't see them continuing to dominate. Certainly on search, there are going to be too many other players out there. So by definition, they're going to have to lose some market share. And plus, they have a government out there willing to break them up. NVIDIA, we're going to have to live with the fact that the rate of change has slowed. So I think you're going to see a lot of portfolio managers reduce that position somewhat. I haven't decided to do that. I've reduced it a couple of times over the last year. I may cut it a little more.
What's your view of the U.S. bank stocks, both the Wall Street banks and the regionals?
You know, this is where I always get burned. You know, I buy into the thesis that these smaller banks are going to do well, and because rates are cut to a company, and there's always some black swan living out there that I don't know about. So I'm not there. You know, the only bank I own right now, and it's expensive, is J.P. Morgan, but I sleep at night.